Hello friends, welcome to the ICICI Prudential Monthly Market Outlook for the month of November 2016. In the last 2 days as I speak to you, there have been significant events in the world as well as in India. In the United States of America, a new president has been elected. The outcome was not something which the markets had expected. However, our belief is that the impact of US presidential elections on India will be limited in any case. So we do not see any negative in the markets because of the change in the US presidency. If you look at the Indian context, day before yesterday, the Prime Minister announced the demonetization of the rupees 500 and rupees 1000 notes. This essentially means that a lot of money which was lying out of the system in the form of currency notes will actually come back to the banking system in the form of deposits. When this money gets deposited in the banks, it essentially means banks have money to lend, which can have the effect of actually reducing the interest rates. So our belief had been that interest rates in India are high relative to the world and that they should come down. Interest rates have corrected from January till now, and our belief is that the next 12 months we will also see a further falling in interest rates, especially led by the increase in deposits in the next 40 to 50 days. With this background in mind, where are we in terms of equity? The equity markets, as I speak, have corrected by about 400 to 500 points. The Nifty is trading at around 8,500 levels right now. In terms of valuation on a price to book metric, Nifty is reasonably valued. We believe that over the next 2 years, the earnings cycle in India will ensure that the compounding earnings in the Nifty will be there. And with the capacity utilization just about picking up, the operating leverage should help the earnings grow better. If you look at every large cap sector, there has been a correction, be it pharma, be it IT, and hence this provides a good opportunity from an investment point of view in fully invested large cap funds or in diversified funds with a large cap bias. Also, if you look at it, the volatility in the world will remain because there is a referendum in Italy which is coming up, and hence we believe that dynamic asset allocation category also should get the attention of investors. So from an investment point of view in equities, we believe that it is a good time from a 2 to 2.5 year point of view investment in large cap and large cap diversified funds. And for those who want to make lump sum investments for a long term period of time, then dynamic asset allocation as a category is something which can be looked at. On the debt side, that's where the interesting part is. We believe that the interest rates can come off over the next 1 year or so, and hence incremental allocation on the debt side should also be looked at. We advise investment in accrual funds and in dynamic duration funds from a debt point of view. From an investor point of view, the way to invest is a systematic investment plan, and within systematic investment plan, the SIP top-up feature actually allows the investor to reach the goals quickly. SIP top-up means essentially every year the amount of systematic investment plan outflow every month increases by set amounts which the investor has pre-described. From a sectoral fund point of view, for those investors who have high risk, high return appetite, they may look at the sectoral funds within the infrastructure space, because this is a space where the government spending is going to be higher in the next 2 years, and it is a space where the last 7 to 8 year returns have not been significant. So from a contrarian investment point of view, infrastructure category is something which the investors should look at. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.